Hey everyone, semiconductor stocks are on fire to start 2024 because of their position to benefit from growing demand of artificial intelligence. In this video, however, I've got one AI stock that's down 44% that I think makes an excellent investment to buy right now. I should say one semiconductor stock, not AI stock. Although this company does benefit from artificial intelligence, it's primarily involved to the EV industry, which is still growing, although much slower in 2024 versus 2022 and 2023. So still, this company at its current valuation makes an excellent investment. Let me share with you why that's the case.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the stock that I'm talking about here is Axcelis Technologies, which is down 44% off its high in a rare semiconductor stock that's not up significantly so far in 2024. Now, looking at its recent developments, the company expects to generate 1.3 billion in revenue in 2025. And given the company's excellent profit prospects, which I'm going to share with you in just a little bit, revenue growth leads to significant increases in profit and cash flow for this excellent semiconductor company. Let me share with you the longer term 1.13 billion in revenue in its latest trailing 12-month period. You can see that's up from roughly 400 million in 2019, so it's almost tripled its revenue. And if it does achieve that outlook that it forecasted for 2025, that would be a roughly tripling in revenue in about 5 to 6 years. Now, this company has got strong prospects longer term, but I'm more impressed with the company's demonstrated profitability. One of the things that I discuss very often is economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand why that factor attracts me so much as an investor, you can see Axcelis Technology certainly demonstrating economies in scale. Its operating profit margin of 23.51% is up significantly from the roughly 12% in 2019. And given it expects revenue to accelerate by roughly another 200 million over the next year and a half to 2 years, you can see this profit margin rising even further over the next few years. The other financial metric I like to look at quite often is cash flow from operations to sales. And this metric totaled 13.87% for Axcelis, and that was up from roughly 7% in 2019. Again, demonstrating increases in this metric. The company is self-sustaining, right? Generating cash flow from operations for several years now. The company has a strong balance sheet, hundreds of millions in cash and no debt. So all of those factors are working in its favor. And finally, I want you to understand why I use the price to earnings ratio to determine if a stock is expensive. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that you've understood that metric, you can see that Axcelis Technologies, I hope I'm pronouncing that right, is trading at a forward price to earnings of 12.84, which is roughly half of its peak valuation of around 28 it was trading at in late 2024. Of course, this slowdown coincides with the slowdown in electric vehicle industry demand. Although Axcelis is in a better position if you're looking to invest in the growth of electric vehicles than investing in any one of the EV companies. That's because overall demand for electric vehicles is growing. The trouble I've been stating with electric vehicles is that there's too much supply. Supply is increasing at a much faster rate than demand, which is forcing companies to slash prices, increase advertising, and lose lots of money on the bottom line. But if you're supplying the industry, you're benefiting from the growth of the industry. Even if the growth of the industry is going to slow down, it's not going to be as quick as most EV investors thought it would be. I was signaling that the industry demand was going to take much longer for people to switch over to electric vehicles. They're just not as convenient as internal combustion engine vehicles, and they're more expensive. Nevertheless, Axcelis Technologies trading at a forward price to earnings of 12.84, given its revenue growth prospects, its profitability, and its cash flow generating ability, I think is an excellent semiconductor stock for investors to buy today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.